I want to thank you all for joining us on this Think Tank Exchange. Today, we are sponsored by Armada and their ETF HAUS, HAUS, which is focused on residential real estate in the liquid public market. We'll distinguish those two. We got a great panel of experts. So I'm going to kick it to my friend, Phil Bach, who introduced himself, and then we'll go through the rest of the panelists and we'll get this conversation rolling.
Thanks, Mike. Yeah, it's really fun to be here and do this. Ultimately, my name is Phil Bach. I'm CEO of Armada ETFs. As Mike mentioned, we manage a HAUS ETF. You can see the banner on every screen, so shouldn't be much of a mystery. But really what we're trying to do here today is really understand the divergence that we've seen between non-traded REITs and public REITs in their valuation. And these things fluctuate. You could expect some divergences over time. There's some differences or some quality differences and different things, but this divergence has widened to a pretty, I would say a laughable measure, to a degree that's really unexplainable by any rational view, other than to say there's a systemic reason. And what is that systemic reason? And we think we've identified it. We think it's built into the structure of some of these non-traded REIT funds, and we're going to get into exactly why and how that came about, and more importantly, what that means to you if you're an investor in one of these funds, or if you're looking for an opportunistic way to invest in real estate in an efficient way. So thank you for joining us, and look forward to jumping in.
All right, so then why don't we jump to Auerbach, and then we'll go to John, and then Chris. Just introduce yourself, let everybody know your background, and then we'll get deep into the conversation.
Thanks, Mike. Great to be with you guys today. My name's Dave Auerbach. I'm the managing director of Armada ETF Advisors. I've been in the REIT industry for almost 25 years as an institutional trader, corporate access analyst, among other things. I'm also the publisher of the daily REIT newsletter. It's an industry-wide follow publication covering the ins and outs of the publicly traded REITs across the spectrum, and very active on Twitter. I'm at Daily REIT.
All right, John, you're up.
Great, thank you. John Guiney. In addition to helping the HAUS guys, I'm on the board at Plymouth Industrial REIT, and I'm on the advisory board at Artemis Real Estate Partners. Prior to that, I've had a number of long-term jobs in the 40 years in the business, including CIO of Charles E. Smith Residential, no longer in existence, but at one time a very prominent apartment REIT. Also Duke Realty, which was recently purchased by Prologis. I was the CIO there. And 15 years of research at Legg Mason, which merged into Stifel, covering office, industrial, and multifamily REITs.
Well, you don't sound like an expert at all. No, I'm just teasing. That's amazing. Chris, I hear you're going to impress us even more, so fire away.
Oh, I don't know. I'm Chris Volk. Good morning. And I've taken 3 REITs public on the New York Stock Exchange. First one in 1994, and then 10 years later, and then 10 years after that. So I've done 3 public REITs. 2 of them I conceived and co-founded. The most recent of those was a net lease REIT called Store Capital, which I started with some other folks in 2011, and grew to be one of the top net lease REIts, and included investors such as Berkshire Hathaway, being their only REIT holding. And I stepped down at the end of 2021, and am proud to be and happy to be an advisor for Armada and for HAUS.
Wonderful. All right, so Phil, I'm going to kick off the discussion. And maybe start with you to put the background, right? So what happened, right? What happened in the private REIT investing space in the last 2 weeks that really sparked the Substack and the thread and all the information that Armada's been putting out there?
What happened most recently was Blackstone put up gates on their B REIT fund, as did Starwood on their S REIT fund. But I don't think the story starts there. In fact, we've been looking at this, and Chris and John and David and I, we've been looking at this and warning about this in a small way long before those gates came up. This was not an unforeseeable outcome. Again, because of, in some respects, because of the success of the fund. In some respects, the fund has become a victim of its own success, but also because of some of the structural inefficiencies, I would say, the way the fund is managed or structured rather. And also because, like I said, I talked about the divergence between the valuations of the two. And I think, just to kind of set the table here, it's important for people to understand that when you're talking about the valuations of a REIT, a publicly traded REIT is marked to market typically on a daily basis. It's traded on the exchange. There's a lot of liquidity, and the market decides what these things are worth based on people, voting with their dollars. What are they willing to buy at? What are they willing to sell at? And when we talk about these non-traded REITs, typically, and in the case here of Blackstone, and John will talk in more detail, but they use an appraisal-based system to estimate what they're worth and to therefore calculate the NAV. And there's nothing inherently wrong with an appraisal-based system. The appraisers that they use are top class, and they're very thorough in their evaluations. The problem is those evaluations get stale very quickly, and they especially get stale in an environment where the market turns very suddenly, which, by the way, happened in recent months. So we're coming out of an environment where, everyone's got unlimited capital and liquidity, and, the market's up with no volatility for so long, and we're not in that environment anymore. And the new reality has yet to be reflected in these old appraisals and these old NAVs. So you kind of put all that together and you get this, perfect storm of, valuations that have to come down, less liquidity in the market, but investors demanding liquidity, less inflows coming in to offset redemption requests. And all of a sudden now Blackstone has to go sell properties, which is going to force the NAVs down. And that's kind of from a high level what we've seen before we dig in deeper.
Okay, can I jump in a little bit there?
Yeah, I was going to ask who wants to jump in on the deeper, because this whole appraisal thing blows me away. It does sound like, the FTX world where people are just making up values of tokens, right? So go ahead, John. Let's get deeper.
Essentially, if you read the fine print, what you learn is the appraisal is really a discounted cash flow. And in the public documents, what BREIT will do is they'll tell you their discount rate and they'll tell you their exit cap rate, but they won't give you all of the important information in generating a discounted cash flow. It is not based on sales comps. It's not based on replacement costs. It's simply based on a discounted cash flow. And if you do the math, what you'll find out is that the discounted cash flow methodology has taken BREIT up to $15 a share. That's about a 3.8% cap rate on in-place income, which is a very, very low number relative to the public markets. I think the public industrial REITs are trading in the low fours, and the public multifamily REITs are trading in the high fives. So to trade at a 3.8 implied cap rate is a very, very aggressive valuation. For example, if you were to take the BREIT income stream and assign a 5 cap rate to it, you'd come up with about a $9 a share net asset value. So it's the reason we think you have a high degree of redemptions is enough people have figured that math out.
So it's funny, we already got a great question in the chat that comes from this, and just whichever one wants to take this, go with it. But the question actually comes from Jim Carroll. Will they need to sell properties, right? So if you're telling me the properties are not priced right, are they going to be forced to sell them? Is there a run possible on these funds?
Well, what you have right now is you have a wholly owned real estate per a $15 NAV is about $118 billion worth of real estate. And if you have a 20% annual redemption requirement, you're talking around $24 billion of sales in the next 12 months.
Wow. Okay. So here's the big thing, right? So we have this market where Blackstone and others have really cornered it. They've bought tons of these assets, and they've taken retirement assets from investors, from various different people, institutions, everyone's in. And then one day they just put up the gate and said, you can't get your money out anymore. So we covered this on the spaces a little bit last week, but we promised everybody we'd have the experts on to tell us a little bit more of the reality now. But if you're in one of these private funds that have now gated, what can you do?
Chris?
Well, I mean, the funds have said, I think in Blackstone's case, if you want to be redeemed, you have to put in a request for redemption every single month to be redeemed. So there's a limitation of 2% redemption per month, 5% redemption per quarter, and then they'll put you on a, they'll give you a pro rata redemption on that. And of course, as John points out, 5% a quarter is 20% of NAV a year, which would imply a substantial amount of property sales if they were to try to fulfill that. And when you're dealing with a REIT that's got a $70 million equity NAV and well over $100 billion worth of that's a $70 billion equity NAV and well over $100 billion in real estate, that's a lot of real estate that could be coming to the market. And that's really all you can do. Otherwise, these REITs were really designed for people to sit there for a long time and to invest and not be able to do this. The liquidity door was not supposed to be, liquidity just like with every REIT. And there's a price for liquidity, which is price discovery, which is what REITs do every single day. You get price discovery. And so with price discovery comes a lot more disclosure, a lot more discipline. You're being looked at by analysts. People are evaluating your numbers. So in August of this year, late August, I wrote an article in Seeking Alpha. And for those of you who haven't been on Seeking Alpha, it's sort of a website for democratization of research, where a lot of people publish on public companies, but nobody would really publish on BREIT because it wasn't public. So, but I thought it would be just worthwhile to write an article on BREIT and compare it to a public company, as if I were an analyst looking at BREIT and just seeing how it did. And I've had an interest in this for a long time because my career started in the private REIT space, so going back into the 80s. And what I found was that basically what others have found, which is that this is a company that if it were public today, it's doubtful it would trade for anything close to what it's valued at on an NAV basis.
Mike, you're on mute. But, just to jump in, this one of my favorite stories from the global financial crisis was hearing that one of the credit rating agencies, they had in their model, they had no correlation between defaults on homes and declining home prices. They had a model that said, well, home prices on average, go up X% a year, and there's a possibility that they'll go down. And they had a model that said that people might default on the mortgages, but they didn't bother to build in a correlation. And obviously, the two happened at the same time. And, I think about that because we think about now, it's like the only time that they're going to get a lot of redemption requests in these funds is when the real estate market is unfavorable, right? And we have that now. So these things aren't unrelated. They're highly correlated together. The value of real estate assets are dropping. The redemption requests are going up. And now, when we talk about, 20% per year out of $118 billion real estate portfolio that they might need to find liquidity on, well, the biggest buyers of these properties were Blackstone and Starwood, and they are not only no longer buyers, they are now forced sellers. So it's a very difficult situation for them to be able to find liquidity now.
Yeah, sorry. So I was muted because I was on my other screen trying to find your article, which came right up. So I put it in the chat for anyone who wants to see. And what I was really starting to get into was this liquidity question, right? So we're the ETF think tank here, right? Liquidity is one of those things that we call the client alignment factor of the ETF industry. It's why it succeeds, right? We always reference transparency, lower cost, liquidity. Those are the types of things. So let's just juxtapose these structures, right? Or chassis. I was with Eric Balchunas from Bloomberg yesterday. He likes to use the word chassis for ETF. So you have the concept of investing in real estate. And you could go buy a home directly, which most of us end up doing, and but then as an investment in that area, we have this chassis of private funds, and we have this chassis of liquid ETF market or public funds. I don't know, Phil or Auerbach, if you guys want to go through the two different chassis and kind of juxtapose them.
I'll start. First of all, it's great because I'm actually going to be on ETF IQ next week, Mike. I'm so very cool. I'm excited. And it's a great topic because You can look at any one of our constituents in our fund. We're talking S&P 500, mid cap 4, small cap 6, guys that trade millions of shares a day. So if you want to sell $1 million worth of equity residential, you can be done like that. If Blackstone is only redeeming 0.3% of the float in December because they've hit their max, your $1 million order means you're only getting filled on $3,000. And as Chris stated, you got to jump back in line at the beginning of January to try to get on your $997,000 position. We don't know how long that queue has grown based on the stories out in the past week or two. We don't know if it's $1 billion sitting there, $5 billion, $10 billion. Who knows how long the queue is? And as John and Chris could probably talk about more than I can for sure, what if they've already potentially hit that 5% number at the beginning of the month on January 1? What if 5% is already sitting there waiting to be redeemed? With the public REITs, you hit on one of the key buzzwords about public REITs. And if you go to NAREIT, the National Association of Real Estate Investment Trusts, they have a great education platform about public REITs, non-traded REITs, this whole thing. But one of the things that they always emphasize about public traded REITs is transparency. These companies announce quarterly earnings, put out regular press releases talking about property transaction, cap rates on their deals, going in, coming out, any relevant news. Not only that, they host quarterly earnings calls, Q&A with analysts, investors, investor relations departments that actually answer investor questions about what's going on. They work with the street, and Chris could talk more about this. They work with the street on the model. And so an analyst would reach out to the company and be like, hey, I've got your Dallas properties at a 3.4 cap rate. And the company would be like, you're way off, man. You need to adjust, and here's why. They're very transparent. They show their hand and they let you know. Versus the public REITs, and we're at the mercy of them telling us once a month what the value is, once a quarter what's in the portfolio, what's going on. Their reporting is just very antiquated compared to the publicly traded guys. Chris, John, do you guys want to go in more on this?
Chris?
As you say, I was going to go into it from a slightly different tack, which is sort of the relative business model. So you talked about, Mike, you talked about the vehicle, and the thing about the vehicle is that private REITs going back a long time have had certain problems relative to public REITs, just intrinsically. First is that to sell a private REIT, what you got to do is you got to sell it through brokerage houses. It's the highest commission product that they sell. The commission on the BREIT product, for example, is over 9%. 3.5% of that's paid up front, and then the rest of the 9% is paid out over the next 7 years or so. But it's a huge amount of money, whereas your average REIT that's doing, especially at the market offerings, is coming in for just a very small fraction of that kind of a cost. So the cost of raising the equity is enormous. What makes the cost even worse is that when private REITs raise the money, they're raising all the capital up front. It just comes at them in bucket loads. In the case of BREIT, they were raising $2 billion a month. And so if you're an investor, what's happening is you're getting the dividends on that money immediately, notwithstanding the fact that the money is not even invested. So it's before it's sitting there being paid out to invested in an industrial property or multifamily house, you're getting the dividend anyway, which basically is another form of front-end load because there's nothing to pay you that dividend except for the cash that you put up. So the load is really more than 9%. It's probably like 11%. It could be even 12%. So you're starting behind the 8 ball day one when you have a private REIT because you got like 89, 88 cents in the dollar going into the ground instead of 100 cents in the dollar going into the ground. The next problem is that the management fees tend to be very rich. I mean, the price to run BREIT. I'll just give you an example of just sort of the cost, and I'll start off with the company I used to run. So the company I used to run is a net lease company, and those are super efficient and they're cheap to run. The cost as a percentage of assets is about 60 basis points, all in. That's management costs, everything. The cost to run BREIT is 3.5% of that. The store's equity cap was $9.5 billion. BREIT's equity cap NAV most recently was $54 billion, I think, and so it was costing like 6% of NAV to run it. from a management fee perspective. And for us, it was 71 basis points. But if you compare the cost of BREIT to run that company relative to EQR or Prologis or any other huge company, the delta is enormous. So the thing is that the only way you can generate higher rates of return is you just have to have really smart investors that are running it. They're going to create alpha, but they're starting so far behind the curve. It doesn't really matter who you are. You're starting so far behind the curve. It's really super hard to create alpha over the long term. And so for that reason, just the business model is compromised relative to the business model of a public REIT. And so David talked about just the sheer transparency that public REITs have and the discipline that imposes on those REITs, that people would actually read your financial statements and they question you. Is that really what adjusted funds from operations is? Is that, what's distributable cash flow and so on? They're going to give you those questions and those hard questions, and you're going to have to be accountable for that. In the private REIT space, you can't do that. I mean, as far as I can tell, in the private REIT space, I can't, there's no place I can look at on a website to say, what are the comparable returns of private REITs over a long period of time. I can't actually find that. I can get that with public REITs. I can look at the history. Can't see it with a private REITs. But what I know is that private REITs just have a very difficult time from a business model. So in the 80s, we did some what would be private REITs today. Our returns were kind of like in the 8 or 9% range, most likely, over the long term. But the thing we had going for us was that our cap rates were 12%. I mean, you could really do a lot with a cap rate that's 12%. When you're investing, as John implied it, cap rates of 4% or sub 4%, and you're having these kinds of loads, it's very difficult to be able to generate nice rates of return.
Okay, so I've heard this term in the Substack and the spaces about the smoothing issues. I mean, that just sounds like Wall Street speak to me, and I would love you guys to describe what that is when they're looking at these valuations and things.
Right. So if you look at the article I wrote in August, there's a graph in that, and it goes through the second quarter of this year. So it goes from December of 16, when BREIT got started, to the second quarter of this year. And in all those quarters, there were only 2 quarters that had a negative rate of return. So the returns were just kind of inching up quarter by quarter by quarter, and it's a very smooth line. And so and then there's a comparison between that and VNQ, which is which basically mimics the long-term REIT index, and it's done by Vanguard. And if you compare that, if you look at them, you can see much more volatility in the VNQ and no smoothing at all, right? So there's a price discovery every single day, which is welcome to the market. That's what happens.
So when you're comparing, you're not comparing apples to apples. When you're comparing the risk side of these two structures, right? Obviously, and you see this with private equity and venture capital and different investments, the more seldom that you report returns, you're going to have less volatility. So you have to manage that. And there are ways to do that. There are ways to manage it. But it's important for investors to be aware of it. And, a lot of the private fund guys will say, well, this is a good thing because the public funds, the public funds are too volatile. They overreact and jump around up and down. If they truly believe that, I would challenge them to become arbitrators, and they can, sell every rip and buy every dip, and they can themselves manage all that market volatility. If they had so much conviction that there would be mean reversion every time there's a big market move. Obviously, that's not what they do. That's a very tricky thing to do, a very risky thing to do, because at the end of the day, we only know what we know at the end of each day. And that's what mark to market is. We believe that transparency, at the end of the day, transparency is a good thing. It's a net good thing for investors. And, this idea that the less liquid and the less data that you have, so you get this smoother return stream, it's a mirage. It's what Cliff Asness has been referring to as volatility laundering. You're taking, you're building in a system where you're going to have less volatility on an apples to apples comparison, and then marketing that as an advantage when in fact it's not. It's really just a different way of looking at the returns.
Interesting. So a couple of advisors on the Think Tank Exchange here asking some questions. There's one in here about the major REIT indices and what they're tilted towards now. Aren't they all just warehouses, towers, and storage? Is that true also for these private funds? Are they tilted towards any particular subsector of the REIT market?
I'll take a stab at that. So the answer is Not all of the indexes are necessarily all towers, data centers, and industrial. It does make up a big portion of it because they have the largest market caps today. But again, we still have a lot of large REITs that are out there like Equity Res, Mid-America, guys, met several of our constituents in the S&P 500, American Homes for Rent, Invitation Homes. Like these are very large cap type companies that are in these funds. In addition, in the private REIT, like if you look at B-REIT, more than 50% of the portfolios is in residential. A big portion of it is industrial. A small piece of it is in data centers or student housing because they just acquired a big student housing REIT, American Campus. But there is a bunch of other stuff in there like hotels and some high quality retail. They do publish Blackstone again in their 10Q. They do publish a very detailed breakdown of the properties, the locations, the occupancy, and all that stuff. But from a very high level, the VNQ, is skewed towards those higher market cap names. So again, it is the towers, the data centers. But again, inside that, there are several of these residential REITs that are way up in the stack of those portfolios.
Okay. So to that end, I'm hearing a very clear story that, residential real estate or REITs as they are out there, there's a little bit of a headwind here, especially in the private space, right? Because everything's been not marked to market, but marked to smoothing or marked to appraisals. The oldest story in the book when it comes to Wall Street engineering. Now, all that said, we're really here today because you guys have a ETF focused on public residential real estate. So I'm going to ask the hard question, which is, what's the bull case here? Like, if there's contagion in the private market, why is the public market exciting? What is the spread? What is the arb? Where do I get where's my silver lining? Give me the
Mike, you got four guys here. You're going to get four different responses, and I think they're all. So I'll go first.
Okay.
From the very high level, number one, there's a massive supply-demand imbalance when it comes to the housing markets. We simply don't have enough housing supply for the amount of demand that's out there. One, because the starter home is not available to most consumers anymore. Number two, we're operating in a 6+% mortgage environment, as well as a soon-to-be high 4% interest rate environment. As a result, because people can't necessarily afford those down payments and those elevated mortgage payments, that bodes well for all of these residential REITs. We're talking about potentially 4 to 5 million homes in lacking of supply to satisfy the amount of homeowners out there, and tens of millions of apartment units that are going to be developed over the next decade for this next generation of renters that's coming into the market. From a public perspective, if you look at some of these companies that are in our fund, like Mid-America, Equity Residential, EQR, Avalon, AVB, these guys have had management teams in place for 15, 20, 25 plus years that have seen every economic cycle. They know when to go on offense. They know when to go on defense. They know what the supply situation is. For us in our fund, we're looking at migration trends. Where are people going across the country, and which of the residential REIT segments benefit from this relocation? Case in point. Go to Raleigh, North Carolina right now and try and buy a house. It's impossible. You can buy a house, but an affordable house doesn't necessarily exist because that's where all the jobs are going right now. With so many people relocating to Raleigh, people are getting shut out of the housing market. What do? You go rent a single family rental. You go rent an apartment. Interest rates continue to rise. What does that mean? I can't afford the down payment, which means I'm renting for that much longer. So from the publicly traded perspective, these companies are the ones, the single family rentals, the manufactured housing REITs, the senior housing REITs, the residential REITs. These are the guys that are in the driver's seat to deal with all of this runoff of demand because of what's happening in the housing markets. I'll let any of the other guys jump in.
I think that was great, David. I think that was really good. I mean, look, from a real simple standpoint, we just looked around at the REIT market. And, the reason why we launched this fund is we wanted to invest, we wanted to build a fund that we would invest in. We said, well, where do you want to be right now? There's, a lot of reasons for caution broadly in the real estate sector. Where's the good stuff? Where do you want to be? I know I don't want to be in office buildings. I don't want to be in shopping malls. I know the privates are way overvalued. Where is the sweet spot? And this is exactly what it is. For all the reasons David mentioned, the demographic trends, the supply-demand imbalance. And by the way, with rising rates, it's harder for new construction projects to finance themselves. Well, we've got our existing projects that, where the rents are fairly stable relative to home prices. And historically, in downturns of home prices, rentals have held up significantly better. They, during the global financial crisis, they were down a little bit. They were mostly flat for a good, whole year of 2008. But where within this sector, where do you want to be? And to us, it was very clear when you consider the valuations of the underlying properties, when you consider the macro trends involved, that this is where you want to be. And this is the structure that is the most efficient and best for investors, where they have the transparency, the open liquidity, and the better valuations from the public REITs.
I have a couple more points I want to add. Number one, Mike, if you look at all of us that are on the screen right now, all 5 of us are not sitting in an office building. Prior to COVID, all 5 of us would have been sitting in an office building. Work from home is here to stay. No matter how the office REITs try to slice it and dice it and spin it, the work from home component is here to stay. New York, San Francisco, the work week is Tuesday, Wednesday, Thursday, and the office folks are home Monday, Friday. I don't know what office REITs look like 5 years from now. I don't know what the indoor mall space looks like 5 years from now. Here's what I do know. When was the last time your apartment landlord came up to you and said, Mike, I got great news for you, man. I'm lowering your rent next year from $1,100 a month to $1,000 a month. These companies, especially the Sun Belt apartment guys that we're talking about, some of these guys have been able to raise their rents 10, 20%, massive growth over the past couple of years. They're already coming out and saying, look, we're not going to put up the same rental growth number in 23 like we did in 22. But if they put up an 8% rental growth number, look, the name of the fund is the residential, it's this way for you guys, the Residential REIT Income Fund. The residential REITs earn income in the form of rental payments that goes into your pocket as a shareholder in the form of dividends. So in an 8% growth environment, that means hopefully, rental growth goes up 8%, which means incrementally the dividend is going to go up as well. I don't know what office REIT dividends look like, especially when we had 2 of them cut their dividends last week because of what's happening in New York office and some other stuff that's outside the scope of this conversation. But we do know that there is a long runway of rental growth for these residential REITs.
I love this because this is the part of the think tank that I love, is the education part, right? Like, so that question from the advisor earlier about the makeup of a lot of these larger indexes. I remember writing a paper back in 2012 or 13 about, the REIT funds being primarily full of malls, right? And Simon Property, the Simon brothers, they were basically selling stock, and the indexes were buying more of it because there was more float when the Simons were selling. So it was the exact opposite of any scenario you would ever want to do, right? The owners are selling and the indexes are forcing you to buy more. So I love this slice and dice. I'm curious that the big indexes today, what percentage of them is really residential REITs, right? Because this story is really gelling for me now, right? Like I think there was a point 3 or 4 years ago when that REIT came out, a REIT ETF came out that was focused on the servers, right? And people finally got it. They're like, oh, wait, I don't want to own Simon Property Group. I want to own something that's growing. Now, it obviously, there was some bubble aspects to it. But, your average investor today, when they're buying a broad-based, super cheap beta one, are they still getting malls and towers and office space, or is residential real estate a meaningful portion of those things?
The answer is you're getting all of that stuff, Mike. If you use the VNQ example, because it's a passive fund, especially during COVID, what were the sectors you didn't want to be in during COVID? Hotels, offices, malls. Guess what? When they did the rebalance, guess what you're in? Hotels, offices, malls. And so residential does make up a big component of it. But as the advisor mentioned, we have the towers, the data centers that, have very industrials, the Prologises that do have large market caps that would move up towards top. Basically, the S&P 500 guys will dominate. Chris, John, you guys have more insight there.
Yeah, I would also say that if you're, as an investor, I would never personally buy the VNQ. I would not buy the broad REIT benchmarks. And it's because, as David has said, they're top end loaded in certain sectors. The entire REIT market, just to put this in perspective, like the whole thing is $2 trillion worth of equity cap. Apple is more than $2 trillion worth of equity cap. So as important as REIT people think they are, the whole thing isn't all that big, right? And it can get dominated pretty easily by just a handful of companies. I would say that over the next 20 years, we're going to see more sectors kind of become bigger. So they'll probably join the tower guys and whatnot at the top of the REIT spectrum. But in the meantime, if you buy the RMZ or / VNQ, you're really buying, an index that's market cap weighted, dominated by a handful of stocks, which is why, in ETFs like HAUS need to exist. It's important for people to have a choice and be able to take the REIT space and dissect it and be able to concentrate on areas where they have conviction.
John, let's go to you on this as well. This is still that bull case discussion, but a little more granular. What are your thoughts here?
I think what these guys have said is they've articulated it really well. I would add that what you have right now in the overall private real estate markets is price discovery. There's almost no transaction volume whatsoever. There's plenty of equity capital out there looking to invest on the private side, but they're waiting for the capitulation where the current owners deal with the reality of 6% debt instead of 3% debt and higher returns on equity. What that translates to is a very attractive entry point for example, the residential REITs right now. And if you look at the HAUS portfolio, you'll see, and David, you probably have better numbers than me, but I think you're getting into HAUS at a high 5, low 6 implied cap rate on the multifamily portfolio, and you're getting in at probably mid-teens to 2023 FFO multiple. So it's a really an attractive entry point.
All right, so I'm seeing some more questions here in the chat. Number of advisors asking about some subsectors and things like that, which I think we'll hit those in a second. I want to hit on just the education of REITs here. Taking from Chris's paper on 101, we're going to call this 101 kind of questions, but I always love to ask the question to like a new investor, SBA communications, what sector is that in? And they never, ever say real estate, right? Even though it's structured as a REIT. Just for the advisors and the education of the investors that are out here listening to us on Twitter and on the Zoom here, what the heck is the difference between real estate as an investment and REIT? Like, why is SBA Communications a real estate investment at this point? I don't know, John or Chris, or Dave, who wants to cover that? I think Chris was muted, but
I was muted. So, I was distracted for a second. I've got somebody at my house. I'm not working out of an office.
No, I'm in a hotel, so maybe that. But yeah, let's hit on what makes something a REIT and what's the difference with that and public real estate.
John, you want to touch that?
Well, remember, a REIT is just a corporate structure, and it's a tax advantaged vehicle where taxes get passed through to the individual shareholder. And what happens is, our cell towers really real estate, our data centers really real estate, is SBA Communications really real estate. And a couple decades ago, virtually all the REITs were bricks and mortar real estate, and now that's veered off simply because cell towers and data centers are more efficiently owned and have with the REIT tax structure as opposed to a C Corp tax structure. Is that what you're getting at?
Yeah, I mean, right. People would talk about the REIT industry, and it would always irritate me when people would talk about the REIT industry. There is no such thing as a REIT industry. It's a tax election. You're a company. You're ticking the REIT tax box on your return. But what makes REITs so great is that they're required by law to pay dividends. Companies can choose to pay a dividend or not pay a dividend. REITs have to pay out 90% of their taxable income in the form of dividends, and they have to structure themselves to be able to do that. So what you get with these hard asset companies is that on average, they have very low leverage. They're probably 35 to 40% leveraged on cost, right? Now, by the way, if you want to compare that to private REITs are going to be levered more like 60% plus of cost because that's one of the ways they can sort of catch up from the load that they got to put on. So, so most of your leading REITs, if not all of them, are investment grade companies with pretty solid balance sheets and an ability to pay out dividends. And if you look through the Great Recession or you look through even 2020, you'll find that REITs by and large had uninterrupted dividend increases. Certain sectors got hit, of course. Hotels got hit badly. Places where there was social gathering places got hit. Some of the shopping centers got hit, but a lot of them just came right back and started paying those dividends once the stores were open and whatnot. So REITs are just a great place for knowing that you have a consistent dividend stream. It's a great efficient vehicle to not have two layers of taxation, but to have one layer of taxation. There are things that you give up for that. I mean, one of them is that since you're paying out 90% in dividends, unlike Berkshire Hathaway, you can't compound your return all the time, right? And now in the private REIT space, one of the problems they have is that they're paying out, and if you look at most private REIT disclosures, they'll say we're paying out 100% of cash flow in distributions. So they're not retaining any of that cash flow, which means that there's not a lot of cushion between that cash flow and the dividends that's being paid. It also means there's no compounding of growth. So the growth all has to come from just same store rents. That's it. The other thing is that in the public REIT space, a lot of REITs in the public REIT space are trading above net asset value. And if you're trading above net asset value, what that means is that you can actually issue new stock to people, and the yield you're paying to those people is less than the yield you're earning on the real estate that you're investing in. And because of that, you can share that spread with your existing investors, and that's called external growth. In the REIT world, analysts will call that external growth, which is basically where you're growing your income per share on the backs of new investors coming in that are helping out the existing investors. In the private REIT space, you get none of that, right? Because all the stock is being sold at NAV. The whole thing's trading at NAV. There's no spread, zero. So in the case of REITs, you got three sources of growth. Privates, you got one source of growth. So the public markets are just a great place to be, and you can buy companies as diverse as cell towers to outdoor billboard signs to straight up real estate companies and housing companies across the map.
I love that you just clarified that, because I always had the same story with MLPs. People are like, oh, MLPs are sectors. No, it's not. It's just a structure. And you saw the same kind of drift, right? Originally, MLPs were almost all oil and natural gas stuff, and then they became, Cedar Fair or things that were like playgrounds or cemeteries or Alliance Bernstein. So it's just a structure, but in this case, the structure is actually has some great benefits. Since we have the experts here, I do have some questions coming from the chats that maybe a little bit are off subject, but I do want to cover them. So I've got people asking about two specific REIT sectors. One, the public storage REITs, and two, people asking, is there something interesting going on in the Canadian REIT market? I've seen a couple of ETFs. Actually, I did one at Global X years ago that was focused on Canadian REITs. I always thought it was a great idea, but it never got legs. So I don't know who wants to handle those two. And then I think we'll do kind of a go around the horn and, get final parting thoughts. We do want to thank Armada and HAUS for sponsoring this and bringing the experts to talk through it. But Canadian REITs and public storage REITs first. Who's going to take those?
I'll start, and then I'll let John and everybody. Real quick, they go hand in hand. We're talking about two sectors that have witnessed explosive growth over the past 5+ years or so, a decade. Back in the heyday, if you played Canada REITs, you only had to own like 2 or 3 names and you covered the sector. Now they lag what's happening here in the States, but the Canadian REIT sector has exploded dramatically. A lot of big players. We're talking about Blackstone. Blackstone, we've been talking about them being forced sellers and everything. Blackstone Canada was actually out buying a bunch of warehouses last week up in Canada. So, Canada's another great growth. Self-storage space is just growing dramatically, especially the growth of the third-party platforms. A lot of these storage companies have been talking about the growth of the platform based off of third-party growth. The question, it's almost like storage today is like what industrial's been the past couple of years. How long can the machine keep growing just at the explosive numbers that they've been doing? John?
A comment I would probably make I can't talk much about storage or Canadian REITs, but I would say that, when Blackstone created BREIT and Starwood did the same thing, their focus was primarily industrial, primarily multifamily, and those turned out to be very astute investment strategies, and they've lasted for 4, 5, 6 years. So both BREIT and SREIT deserve a pat on the back for being very, very astute in their in their investment strategy. Because even now we're thinking, and David, you're probably closer to this than I am, but 7+% FFO growth, 22 to 23 for the multifamily, same high single-digit FFO growth for industrial, and that's even with the headwinds of a significantly 200, 300 basis points increase in interest rates. So we give them credit for what they've done. We tend to think HAUS is a better mousetrap and a much more efficient way to own the real estate, but you do have to give them credit for what they've done in the last since inception.
All right, so this is great. We just got another great question that came in the chat here. I want to hit that, and then I want to go around the table on, where we started, right? What's happening in the private versus the public and what happens next. But there's a question here that I think is really directed towards Chris, and it's an interpretation that the way you were describing things suggests that there's going to be kind of new subsectors of the REIT, I guess I don't want to say industry anymore, but use of the REIT concept. And they're asking if you could share your thoughts on what those could be. Like, I don't know that any of us thought cell towers were going to be REITs. Maybe you did. Just kind of any predictive ideas of what else could use the REIT structure or chassis that then I can come in and put into an ETF wrapper with you folks.
Sure. Well, just at a high level, if you look at REIT exchange traded funds, it's dominated by 3 or so names, and that have the lion's share of the capital, and those names all have kind of the same companies in them, and they're all equity based. They're all equity balanced, equity cap based ETFs, dominated by your cell towers and your large cap REITs, your industrial REITs like Prologis and whatnot. And so I think, as a result of that, you're seeing the emergence of some sector specific ETFs, and HAUS is one of those, dealing with a very broad space of the REIT space. Another one that I know of is NETL, which is close to me just because I was in the net lease space. So there are a bunch of net lease REITs, and so if you want to do a blanket, you could do NETL. And there are, I'm sure, David could probably list a few others. But there will be more. This is an embryonic thing, I think. I think it's going to be building on itself, where you're getting more and more sector-specific ETFs. And I think the world needs this. And the world needs to move away from sort of the broad-based REIT ETFs, because the broad-based REIT ETFs, they don't all trade in the same way. And by the way, the business models, just the underlying business models of these companies are so far different. What a self-storage company, what it takes them to succeed versus a cell tower company. It's like night and day. And so having some index where you're combining self-storage and cell towers, just because they have a REIT behind their name, is almost ridiculous on its face. To think about it. So you really want to have, ETFs like HAUS and others. And if it were my world, I would radically shrink these large REIT ETFs that are basically based upon the overall REIT sector, because it's not an industry. It's just a composite of a lot of different sectors and industries that each have their own characteristics and bear investment strategy and bear investment focus. So
Awesome. All right. So we got about 10 minutes left. So I think we're going to use these last 10 minutes to go around the horn. I'm going to start with John. And the primary question is what happens next, right? And you can take that and go with it, excuse me, on residential real estate or on BREIT and all the things that are going to come from this. Just for our investors out there and our researchers, what do you see happening next?
Oh, I'll focus on BREIT a little bit. Is first, they have, if you look at their balance sheet, they have plenty of liquidity. I'm looking at the September 30 3Q balance sheet right now, and they have 10 billion of investments in real estate debt, which are highly liquid. They have $1.5 billion of cash. They just sold their interest in a big casino in Las Vegas. If you talk to the investment sale brokers in the area, what you'll find is they've got a lot of small bay industrial product on the market. So they've got a lot of liquidity. They have a lot of assets in the market for sale right now, but they still felt it necessary to gate to limit redemptions to 2%, 5%, and 20% per annum. So we think there's just a lot more news coming out there. And we think that when you look at you peel back the onion and you see that right now, $15 a share translates to about a 3.8 implied cap rate. You really do have to wonder what the correct NAV should be. And I think most people would probably circle around a 5 cap, and that's about $9 a share. So I would say that there's a lot more news, and the BREIT story has only begun to surface. So you'll have a lot to talk about for the next few quarters.
All right, Auerbach, your parting thoughts?
I always like to say the REITs are boring. Slow and steady wins the race. We're focused on that 5 to 15% of the left side of the portfolio. With all the headlines that come out every single day, today with SBF, return to office, Kathy Wood, ARK, Tesla, ultra short, any of this other stuff that's out there, we're just focused on the here and now, what's going on with residential. I'm just focused on what I know, what these companies are telling us. As I like to joke with my friends, I don't have to do any work because I've got the US government, I've got Zillow, Redfin, RealPage, all of these data sources telling me what's happening in the world of residential real estate and where people are going. And because we're active, we're just trying to basically, find those sweet spots, where the people are going, which of these segments are benefiting, and how can all investors benefit from, not my wisdom, it's from John and Chris on the screen here, and how they could benefit from the entire team's collective wisdom.
I love that you want to call it boring, but it sounds like a lot of crazy stuff is happening and a lot of opportunity is out there. But I get the concept, right? Like it's kind of that Warren Buffett, let's be boring about our investing, buy what you can understand. And I think every investor, everybody in research right now can certainly see that rents are going up, right? And I think it's like when people first hear HAUS residential REIT ETF, I don't know if they realize what they're buying is rent streams. Like you're buying rent, you're a landlord, right? That's required to pass 90% of that rent on to you. All right, Chris, let's go to you for your parting thoughts.
Well, I mean, John Bogle was right, and when he built Vanguard up, it was based upon the notion that investors were going to get alpha delivered to them in part by having very, very efficiently run mutual funds and ETFs with very low fees structures, and the private REITs are trying to run counter to that. They're saying, I can create alpha, but I can do it in a private vehicle with a super high fee structure, both on the load going in and on the management fees going forward. I think you can't do that. I mean, I think that history has shown you cannot do that. That people, there aren't a select group of people smart enough to be able to create the alpha to get that accomplished. But in the meantime, Blackstone has a terrific name. They've done a magnificent job building the business, and so when they launched BREIT in 2016, it came with a lot of fanfare. And as the public REITs were kind of lagging a little bit, over a 6-year period of time, they've raised so much money that if they were listed today at the NAV they report, they would be the country's 5th largest public REIT. I mean, they would be an enormous force if they were out there in the public marketplace. I think that with this gating issue, what we're seeing is that the private REIT structure is just compromised. I mean, and it has issues. If people thought they were going to get liquidity, they can't. You can't get liquidity without a lot of price discovery. If people think that they're going to outperform over the long term, I think that that's just possible, but not likely. It's just the front end load is you're fighting against John Bogle's legacy. And I think that's going to be a difficult one to win. And so I think that the place you want to be is in the public sector. Then if you want to get into a diversified pool, because most REITs are not, most REITs are specialized. They're doing, housing, or they're doing industrial, but they're not doing a panoply of real estate. So if you want to get into a diversified group of real estate, which is what BREIT is, and if BREIT were a public company today, it would be very unusual as a public company in the sense that it has, single family, you're mixing single family housing up with multifamily housing, with industrial assets, and with student housing and the like. So it would be a much different kind of public REIT than anybody has ever seen. So most REITs tend to specialize. So if you're going to do that, then you're best off doing it by either buying a lot of public REITs or by buying into specific REIT ETFs like HAUS. And that's why HAUS was created, to be able to take advantage of that. And it's going to be just a much more efficient way to do it and to generate the kinds of returns people want. And by the way, if you look over time, and again, the irony here is that private REITs have been sold oftentimes on the basis of volatility, where you're thinking, okay, I don't want to have the volatility of a public market. And they have not. I mean, they've had a very smooth rate of return over a long period of time. But the thing is, if you're a long-term investor and you're, and by the way, half of the BREIT investors are actually reinvesting their dividends. So they're the ultimate long-term investor. So, but in the meantime, you're going to have a certain amount of volatility along the way, but the long-term investor doesn't worry about that. The long-term investor is the guy who's always sort of dollar cost averaging, staying in the marketplace, knows where they're going, and realizes that they're better off in the public markets with the liquidity and the price discovery they have.
Can I make a quick follow on to Chris?
Yeah.
The whoever, I'm not sure who's on the call, but the one recommendation I would make, if you have clients in BREIT, the thing you ought to do tomorrow is get out of the DRIP, get out of the dividend reinvestment plan, because you're investing at $15 a share when the issue is that that's a artificially high share price, which is almost guaranteed to come down. And if you can't get your liquidity by selling the shares, at least you can get out of the DRIP.
That was very polite calling it artificial, but Phil, thank you for bringing all these experts here. Your final thoughts in the last minute or so that we have.
Yeah, I mean, look, the question was, what's going to happen? We don't know. We don't have a crystal ball, right? But there are probabilities, there are possibilities. The run on the bank scenario with BREIT is a possibility. It's also a possibility that they can, generate some liquidity now or inflows to offset redemptions, and they open the gates shortly. We don't really know. What we do know is that it's a very expensive fund that holds even more expensive, very expensive underlying properties based on comparables that you can get in the public markets. We know that there are liquidity issues with the structure. It's not an ideal structure. So, when you compare it to the public market REITs, there are advantages to an valuation side, of course, but we think transparency at the end of the day is a good thing. So, that's why we created the fund. That's why we created our fund HAUS. It's small, it's new, but, we think this is where you want to be within the world of REITs. We've got demographic trends on our side. We've got supply-demand imbalances on our side. And, we'd love to work with anyone that wants to work with us.
Awesome. Thank you, everyone. I put Chris's paper and the Armada website in the chat there. So anyone who wants to learn more, feel free to reach out. And thank you and have a great day.
Thank you.
Thank
Thanks for having
you.
us.